Canada relies heavily on the United States to sell its crude oil. In 2023, Canada produced 4.6 million barrels of oil per day, with over 80% of that going to the US. This interdependence goes both ways. Approximately 60% of US crude oil imports come from Canada. This is partly because US refineries are designed to process the heavy crudes that Canada produces, rather than domestic varieties. While US refiners also source heavy crude from Mexico and Colombia, those countries do not have much additional volume to offer, according to Dylan White, an analyst at Wood Mackenzie. Iraq is currently the largest potential source for incremental heavy crude imports to the US. Canada also has a potential leverage point. It can reduce oil production. Even a small cut could have a significant impact. In early 2019, the Alberta government mandated oil producers to decrease production to help close the gap between the price of Canadian crude and the US benchmark. A modest reduction of 325,000 barrels a day helped narrow the price discount from about $49 per barrel to $10 per barrel after the cuts took effect, as reported by TD Cowen. There are factors that could offset the challenges faced by Canadian producers. For instance, scheduled maintenance, referred to as a turnaround, is expected to reduce oil sands production capacity by approximately 380,000 barrels a day in the second quarter and by about 140,000 barrels a day in the third quarter, according to a TD Cowen report. This could naturally alleviate the risk of significant discounts on Canadian oil. Additionally, given the rapid policy shifts of the Trump administration, tariffs might be lifted by the time maintenance activities are complete. Another minor offset is that Canadian producers now have increased export capacity to Asia following the completion of the Trans Mountain Pipeline, which connects Canada's oil to its western coast. A group of Canadian energy companies has underperformed compared to a similar group of US companies by about 4 percentage points since Trump took office. Some Canadian firms are better protected from tariffs than others. For example, Suncor Energy and Imperial Oil have substantial refining operations in Canada, and most of their crude production is consumed domestically. This may explain why their stock performance aligns more closely with US energy companies than with their Canadian counterparts. The costs associated with tariffs may not be as one-sided as Trump believed.